Hi traders, welcome back to Village Trader. I'm your host Njabulun Tsibande, also host of the Village Trader podcast, a podcast I host chatting with other traders, trying to learn from them. So in today's video, as it was last Friday, so every Friday I'm going to try and do some thought videos as opposed to charting videos as we normally do on the channel. So in today's video, I want to talk about a perfect trade and why you need to cut your losses. But before we get into that, please do make sure that you subscribe if you're new, hit the bell notification button so that you don't miss any of these videos, and drop a like on this video to show some support. All right, let's get straight into it. So what is a perfect trade? Let's first answer that. So a perfect trade is a bunch of rules or a set of checklists that you go through on each and every trade that helps you become more consistent in your action, which ultimately will help you be more if the rules are any good enough, will help you be more consistent in terms of your profitability as well. So your perfect trade needs to cover your entries, your exits, your risks, and that sort of thing, and make sure that you are in in good standing with your edge and with your goals in that regard. So to avoid that inconsistent behavior, we need to have a written down plan or written down checklist to say each and every trade must pass through this checklist to ensure profitability over a series of trade. It doesn't necessarily mean that now that you have a checklist and this particular trade checks all the check boxes, it will now therefore be a profitable trade. It does not mean that at all. It just means you as a trader are more consistent in your behavior and in your action, and then you let the randomness of the market do its thing. But you will still act in the exact same way. There's a famous quote that you can't backtest your emotions, and that is very true. But when you backtest the system with a perfect trade checklist and say, okay, this is what I would have done here, this is what I would have done here, this is what I would have done here, based on my checklist, you can backtest your system on that. And as you're trading, you need to still keep with that trade, with that perfect trade. And I'll share with mine, which I did in the previous video last Friday. But I'll share my perfect trade and a bit more in detail on each what each checkpoint on my perfect trade is for. So first on my perfect trade, the question is it a valid signal? So in other words, it is a valid breakout because I'm a breakout trend following trader. So is it a valid breakout? What was it a horizontal level resistance or support breakout, or was it a valid bull flag or a falling wedge or a cap and handle? Or a head and shoulders pattern. So is it a valid breakout pattern that I'm trading, right? Secondly, is the trade in the direction of my trend? So first, before I get into that, the reason why I have this question, that is it a valid signal on my checklist, is I don't want to now to take random trades just because that particular trade happens to fit within maybe 3 or 4 of my checklists, or I got a tip from someone that I really trust, or someone that I know as knowing what they do. So if I'm about to get on a trade and I check if it's a valid signal, it'll immediately pop up to say no, it's not a valid breakout. You just got this idea from someone else. But it can happen from time to time where someone brings a stock to your attention, and maybe because they know my trading style, my trading system, or the type of patterns that I trade, they bring it to my attention, and it happens to be a valid a valid trading signal. So, in which case it would pass the test. So second on the list is the trade in the direction of my trade of the primary trend. So one of the things that I look at when I'm doing my charting analysis is I first look for my primary trend direction. That's the first thing. That's the first point of call. Before I look for any charting pattern, I want to decide which direction of the market I want to be looking at. So to do that, I go to my weekly chart because I'm an end of day trader. I trade the daily chart. So I go to my weekly chart and look for direction there. And how I determine the direction of the market, or the direction to which I want to be, or the side of the market to which I want to be in, is nothing sophisticated really. It's just by a pair of moving averages. So I look at my 30-week exponential moving average in relation to my 60-week exponential moving average. And important to note, it's both moving averages are not in relation to price, but in relation to one another. So I look at the 30 in relation to the 60. So if the 30 exponential moving average is above the 60 exponential moving average, 60-week exponential moving average on the weekly chart, if the 30 is above the 60, I want to be long. And inversely, if the 30 is below the 60, I want to be short. So right there, I have my direction of the side of the market that I want to be in on that particular stock, or on that particular. I trade stocks. I don't trade anything else other than some ETFs. On a separate system, which I'll get to in just a sec. So I trade that on a lazy system, which has its own rules and its own perfect trade checklist. So once I've found direction that I want to be in, and I have a valid signal, whether it's a bull flag or falling wedge or head and shoulders or cup and handle or whatever the case is, once I have that valid signal, before I look to enter that position, or look to enter into that trade, I check if the 200-day, now I'm back on my daily chart, I check if my 200-day is behind me. So I need my 200-day exponential moving average to be behind me. I don't want to be facing the 200-day exponential moving. So in other words, when I'm long, the 200-day exponential moving average needs to be below my entry point and or below price as I'm entering. And then when I'm short, the 200-day exponential moving average needs to be above me as I'm entering into the trade. The price can then subsequently trade below my 200-day exponential moving average, or above it, whatever the case may be. I don't, as long as my stop loss hasn't been hit, I don't now suddenly change or want to exit my position at that point. But at entry, I need it to be behind me. What's this? Number four. I want to make sure that I'm placing a stop loss as I'm entering into the position. So when my pop-up window comes up, or my order window comes up, the first thing that the first checkbox that I check is the stop loss order, and then I set the price of my stop loss order and set my target and that sort of thing. But my stop loss needs to be there at entry. No matter what, my stop loss needs to be there as I'm entering into the position. And so a bit more on the stop loss. So a stop loss is a predetermined price point to which you will not hesitate but exit the position. You will not wait for another ticker. You will not wait for another day. You will, once the price point gets there you exit the position, which is easier these days because most platforms really offer you the ability to put a pending order on the market to say, okay, when the market gets here, take me out, to put the stop loss order in the market as you're entering, so it becomes a less of a pain to not cut your loss. And I'll get to adjusting the stop in a second, but that price point is a price point to say, pure market is not going there before it's going to my target. That's essentially what a stop loss is. And once it gets there, it means your analysis or your thesis or whatever reason that you use to get into the trade has been negated. And it doesn't matter who negated it, for what reason, and why was it negated. It just means that it's been negated and it's time to exit the position. And as I'm entering the position, my position size, I wanted to risk less than 3% of my account equity. So I allow at this point I allow myself a little bit of room to work with. So I can risk anything between 1% and 3%, but not more than 3%. And the only reason why it's 3%, it's mostly 2%, but the only reason why I'm giving myself up to 3% is one, slippage as I'm entering into trades. Secondly, I continuously fund my account. So if for whatever reason, I feel a bit more confident on this trade, or I can see there's a bit of volume on this particular trade, I can risk 2.5% or 2.8% on that trade, but not exceed 3%. On that position, and that really mean what it really means for me is that it keeps me on the game for long enough, and it keeps me available for the next play or for the next edge in the market, and it just makes sure that I don't lose too much on any one trade that I take. I don't lose an inordinate amount of capital on any single trade, so I'm there to allow the probabilities to play themselves in my favor over a proper sample size of trades. Let me just sip a bit of tea. So next on my perfect trade list is, did I monitor this trade correctly? And by that I mean, did I check it? I check my charts on a daily basis when the market is closed. Did I do that? And secondly, when I'm adjusting my stop, did I adjust my stop in the direction of my trade? So in other words, when I'm long, that stop needs to go higher, and when I'm short, that stop loss needs to go lower, and not the other way around. And the reason for this, when placing an order, a stop loss order at entry in the market is not enough unless you've accepted that risk. So you need to accept that risk before you go into any trade. And as the market moves in your direction, you can then reduce that risk and ultimately get to a point where your stop loss order is securing a bit of profit. But it's not, adjusting the stop loss should not be against the trend. In other words, you should not increase the risk that you're taking on. And the reason why most traders increase the risk that they're taking on is they believe they're right. And I want to assure you, and you'll get this if you read Trading in the Zone by Mark Douglas. One, you don't need to know what's going to happen next to make money in the market, or to lose money for that matter. Secondly, it takes just one trader to negate your theory. It just takes one. It could take a bunch, but really it just takes one to negate your theory. So in order for you to be 100% sure and 100% right, you need to kind of know what everyone that's participating in that particular asset that you're trading is doing or is about to do. So you need to know the current short sellers of the stock. When are they going to cover? The current long bulls of the stock. When are they going to close their positions? Or the people that are sitting on the sidelines, when are they going to enter into the trade, and which direction they're going to enter in, and which with how much size. So knowing that is it's just simply impossible to know. So you need to predefine a risk and never play outside of that risk, ever. Never play outside of that risk. Never let those big losers clean your account out. So last on my perfect trade target is did I exit the trade correctly? So more often we find where traders focus on entries because that's the easiest thing, I suppose, and neglect the exits. How high is high when you're long and how low is low when you're short. But have a place or have a price points or a strategy of exit as you're entering. Know how you're going to exit the trade as you're entering. So either a target or stop. So I typically exit my trades on target or stop, typically. But from time to time, when the trade is really rallying, I remove the target and trail my stop behind me. And once my stop is covered a significant or what I deem as enough on in terms of what my stop loss has secured in terms of profits, I will then just remove the target and let that run as I trail my stop behind until I get stopped out. And if I do get stopped out and the share price comes back in my direction, I'll just simply re-enter that position, but I will just be trailing my stop accordingly in that regard. And last bit I want to now that we move away from the perfect trade, I hope that helps. And I'll leave the link to Simon Brown's. So the idea for perfect trade is really Simon Brown's idea. I just took it from him and just made it modified it to fit my style of trading, because it's predominantly an index trader. He did story for another day. Anyway, so now I want to talk about the importance of cutting your losers short. This thing it's like an axiom of trading. Cut your losers short, and it's a very, very easy thing to say. Can be difficult at times to do, because that idea of wanting to be right in the market. It's the reason why you need to cut your losers short is to make yourself available for your next play. So first predefine that risk or that price point where you will exit the trade if it goes against you. And when the price gets there, without any hesitation, without any second thought, or without any hoping for a better for the market to make you whole again, you exit the position with no hesitation. Will your stop hit and the market comes back in your direction? Of course that's going to happen. From time to time, of course that's going to happen. But more often than not, it'll continue going lower if you're long, or it will continue going higher. Worse if you're short. But if that price point is hit, exit the position, be ready for the next edge. And if you get stopped and you see the market coming back in, you can always re-enter that trade. And by that, I don't mean now chase a re-entry and enter randomly and haphazardly into trades. Rather, wait for a valid signal again. So once you get stopped out and you're looking for a re-entry into that same trade, it's now a completely new trade, and it's completely what's the word I'm looking for? Independent of its predecessor. So this new trade has nothing to do with that old one. So you need to wait for a valid signal before you can re-enter that position. And from time to time, it will happen where you get stopped and the market really rallies so hard that you don't get a valid signal. Of course, that will happen. But here's the thing with the randomness of the market. Even the occurrence of of that happening is random. So you'll never ever know that this particular trade that's being that's being stopped right now is the one that will bounce back and make me whole, or it's the one that will continue losing me more money. Just as much as the sequence of winning trades and losing trades is random, the sequence of events where you get stopped and the market goes in your direction, and you get stopped and the market goes to go against you, is also just as random. So you can never know. So you need to always protect yourself against the market going against you. And if you want to think about it in terms of being right or wrong, when you exit that position, the only way you're gonna know you're right or wrong is what's gonna happen next. And if the market continues to go lower, if I'm just gonna continue making an example with the long positions. If the market continues to go lower, it means you're right? And if you get stopped and the market turns and comes back in your direction, it means you're wrong. And just as much as you have winning trades, you have losing trades, you have those events as well. So try not to let losers run, because if you let your losers run, they'll diminish your margins or the balance that you have, and you will not be available for your next play or for your next edge whenever that comes up. So that's it from me today. Thank you for chilling with me up to this far. Be sure to subscribe if you're new. Hit the bell notification button so that you don't miss any of these videos. If you like the video, if you like the content, do drop a like on this video. Do get down in the comment section down below. Let me know your checklist. Let me know some of the ideas that psychological ideas that you have on the comment section down below. I'll be there responding and giving my ideas to your ideas, on my thoughts to your ideas, etc. With that being said, thank you for hanging with me. Check you next time with the Village Trader. Cheers.